I mean, imagine looking at a single company, right? And one Wall Street analyst tells you it's going to $600 a share, and another, looking at the exact same data, by the way, tells you it's crashing to $25.28.
Yeah, it's a completely fractured reality. It really is.
Welcome to the Byte-Size Brief. Today we are putting TSLA completely under the microscope. Let's get into it, because if you're looking at your portfolio right now, early April 2026, you know the stock has lost about a fifth of its value this year. And you're probably wondering why the financial world is just so utterly divided over this.
Right. So normally there is a recognizable financial gravity with mega cap stocks.
Yeah.
But for this deep dive, our mission is to look past the noise and look at the hard, objective Q4 2025 and Q1 2026 data. We need to figure out, is TSLA fundamentally a declining legacy automaker getting crushed by competition, or is it a deeply misunderstood AI and robotics juggernaut?
Okay, so compared to last quarter, what actually moved the needle here? Because to understand these wild valuations, we first have to look at the core engine of the company, right? Which is, obviously selling cars.
Exactly. And if you look at the Q4 2025 numbers,
Yeah.
you actually see a very surprising positive signal. Auto growth margins actually improved quarter over quarter. They moved from 15.4% in Q3 up to 17.9% in Q4.
Wait, wow, okay. I mean, in a market where everyone is slashing prices right now, increasing your margin by over 2 full percentage points is no joke. How did they physically pull that off?
Well, it largely comes down to localized supply chain efficiencies and the scaling of something called 4680 cell integration.
Right.
And this is a massive, but while the margins on the cars they did sell went up, the actual volume of cars being sold is dropping.
Okay. The volume is the issue.
Yeah, for the full year of 2025, vehicle deliveries fell 9% year over year, down to 1.64 million units.
Yeah.
And because of that contraction, they have officially lost the global electric vehicle volume crown to BYD.
Man, that is a huge shift. I mean, you look at the broader market right now and you just see this absolute flood of cheap EVs pouring in from legacy automakers like Ford, right? And General Motors, not to mention BYD expanding globally with these just incredibly aggressive pricing strategies.
Right, but what does all that actually mean for TSLA investors? We have to stay focused on them.
Good point. Hold on. How does that actually affect TSLA's stock price for regular investors like me? Because looking at retail sentiment, people still say these cars are incredibly reliable. They just work.
They are reliable, sure, but the issue is the growth trajectory. See, Wall Street prices TSLA as a hyper-growth tech company, not a mature, flat-mining automaker. If the growth stops, the valuation collapses.
Right. Okay.
Let's look at the Q1 2026 delivery consensus. Right now, analysts are projecting roughly 366,000 vehicles delivered for the first quarter.
Okay, but wait. If I look at the historical data for Q1 2025, they delivered about, 336,000? So 366,000 is actually a 9 or 10% year-over-year increase, right? That sounds like growth is back on track.
Yeah, you would think so, but that year-over-year bump is entirely an illusion.
Wait, really? How?
You have to remember what happened in Q1 of 2025. TSLA had massive, extended factory shutdowns worldwide to retool their assembly lines. That artificially depressed the 2025 baseline.
Oh, I see.
Yeah, so if you look at the sequential data, which actually tells you what consumer demand looks like right now, that 366,000 consensus represents a steep 13% drop from the 418,000 vehicles they delivered just last quarter in Q4.
Oh, wow. So they're masking a quarter-over-quarter bleed with an artificially easy year-over-year comparison. That is a classic optical illusion.
Precisely. And the underlying cause of this demand weakness isn't just competitors offering cheaper cars. We have hard data pointing to severe brand erosion.
Oh, really?
Yeah, according to recent global valuation reports, the brand value of TSLA dropped 36% in 2025 alone. That wiped out about $15 billion in intangible value, bringing it down to $27.6 billion.
What causes a 36% brand drop in a single year? That's catastrophic.
Well, the reports largely tie this erosion directly to political noise. Specifically, the consumer data shows a significant backlash tied to the CEO's deep involvement with the Department of Government Efficiency, or DOGE.
Gotcha.
And just to be absolutely clear to our listeners, we are not taking any political sides here. We're strictly looking at the market data provided in our sources. And that data impartially reports that this polarization has actively alienated a massive segment of their historical core demographic. It's led to sales drops of up to 49% in certain European markets.
So basically, it's kind of like they have a great smartphone, but they haven't updated the design in years, and the CEO keeps getting into public disputes that alienate the core customer base.
That is a very accurate analogy. The hardware is solid, but the novelty has worn off, and the brand association has just become heavy baggage for a lot of buyers.
But okay, if you're analyzing the balance sheet, here is where it gets absolutely fascinating to me. If their car volumes are shrinking and their brand is taking this historic beating, how on earth did TSLA manage to report a 20.1% total gross margin in Q4 of 2025? I mean, that's their highest total margin in 2 years.
Yep.
If the auto side is bleeding volume, that profit has to be hiding somewhere else. What are we missing here?
You're missing the hidden compounder for this company.
Yeah.
The unsung hero of their financial stack right now is the energy generation and storage division.
Okay, walk me through the mechanics of that.
So in 2025, the energy division generated $12.77 billion in revenue. That's a 27% increase year over year. But it's not just the top-line growth, it's the profitability.
Right.
In the fourth quarter, this division operated at a massive 28.7% gross margin. They deployed a record 46.7 gigawatt hours globally for the year.
Wait, 28.7% gross margin? That is staggering for heavy physical hardware. How are they achieving software-level margins on giant metal battery packs?
A huge part of that margin expansion comes from the new Shanghai Megafactory. This facility is exclusively churning out their commercial megapacks, and it has an annual capacity of 40 gigawatt hours.
Okay.
Because it's situated in China, they're taking full advantage of incredibly low, highly localized supply chain costs. They aren't shipping raw materials across the ocean. Everything is right next door, but the hardware is really only half the story.
What's the other half?
The real margin booster is their Autobidder software.
Wait, so Autobidder isn't just a battery management tool. It's like an algorithmic trader, like high-frequency Wall Street trading, but for electricity.
Exactly. Imagine a massive, utility-scale battery pack connected to the power grid. Autobidder uses machine learning to predict energy prices, weather patterns, and grid demand in real time.
Oh, wow.
Yeah, it automatically buys and stores electricity when prices are rock bottom-like, in the middle of the night,
Yeah.
and then discharges and sells that power back to the grid during peak afternoon hours when prices spike.
So they're essentially monetizing grid arbitrage.
Yeah.
That makes perfect sense. But let me push back on the scale of this for a second. Does selling giant batteries and trading electricity really move the needle for a $1.4 trillion stock? Or is it just a nice side hustle?
It is rapidly becoming the main event, honestly, because of the global AI boom. We have tech giants building massive data centers to train AI models, and those data centers demand unprecedented amounts of electricity.
Right. They use so much power.
Exactly. And the traditional power grid physically cannot handle it without localized grid-scale energy storage to buffer the load. So TSLA isn't just selling batteries. They're selling the critical infrastructure required for the global AI revolution.
Okay, so they have a shrinking car business, but a highly profitable, booming energy storage business that is just throwing off a ton of cash. Where are they deploying all this capital?
Well, they're betting the entire house on a fully autonomous robotic future. We're looking at a massive structural pivot. In their Q4 earnings call, management laid out an explosive $20 billion capital expenditure plan for 2026.
$20 billion in a single year. That is unbelievable. Are they using that to finally build like a cheap $25,000 mass market car to fight BYD?
No, and that is exactly why Wall Street is so fractured. The $20 billion is not going into a traditional consumer car.
And what is it for?
It is being poured into 6 new factories, massive AI compute infrastructure, the Cybercab, and the Optimus humanoid robot. In fact, they made a staggering revelation on the call regarding their legacy vehicles. They're officially phasing out the Model S and Model X programs.
Hold on. They're killing their flagship luxury cars, like proven cash generators, to build a robot that currently doesn't have a single paying consumer. How is Wall Street not terrified of that capital destruction?
Oh, a lot of analysts are terrified. But the company's rationale is about maximizing factory footprint. They're retiring those legacy models to convert that entire manufacturing space at the Fremont factory into a dedicated Optimus robot manufacturing line. Yeah, they're aiming for a production rate of 1 million humanoid robots a year in that exact same building. They target external sales for late 2026, initially pricing Optimus around $40,000, with a long-term goal of driving that cost down to $20,000.
And what about the cars? If they aren't making a cheap consumer car, what is the Cybercab doing?
Production of the Cybercab begins this very month, April 2026, at Giga, Texas. This is a purpose-built two-seat robotaxi with absolutely no steering wheel and no pedals.
No steering wheel at all.
None. And to make it profitable, they are completely upending how cars are built using an unboxed manufacturing process.
Okay, unboxed. I've heard this buzzword. Explain how that actually works on a factory floor compared to what like Ford or Toyota does.
Well, think about a traditional car assembly line. It's entirely linear, right? You build an empty metal shell, paint the whole thing, and then workers have to physically squeeze themselves inside the doors to install the seats, the dashboard, and the wiring.
Right, which takes forever.
Exactly. If one station gets delayed, the entire line stops. The unboxed method means breaking the car into completely independent subassemblies. You build the front, the back, the floor, and the sides entirely separately, with the seats and wires already attached, and then you snap them all together at the very end.
So basically, it's kind of like building with Lego pieces in parallel rather than trying to build a ship inside a bottle sequentially.
That's a great way to put it.
Right.
It eliminates the bottleneck of a traditional linear assembly line. They're aiming for a build rate of one vehicle every 10 seconds.
That's insane.
It is. It more closely resembles how you manufacture consumer electronics, like smartphones, rather than traditional cars.
It's like they're pivoting from making iPhones to making the entire cellular network and the humans who use it. But let me push back here. Waymo is already out there picking up passengers, right?
Yes, they are.
Waymo has actual paying customers in driverless cars right now in places like San Francisco and Phoenix. Aren't they already losing the robotaxi war?
Waymo is absolutely winning the current localized deployment battle. But the bull thesis for TSLA hinges on the mechanism of their data collection. They currently have 8.4 billion miles of full self-driving data collected from their global fleet. That is 42 times more real-world driving data than Waymo has.
Wow. And why does that massive volume of data matter so much?
Because Waymo relies heavily on expensive LiDAR sensors, which shoot lasers to map 3D space and highly mapped geofenced areas. TSLA uses a vision-only AI approach.
Just cameras.
Exactly. They rely entirely on standard cameras and the AI brain to infer depth, just like human eyes do. And to train that brain, every car they've ever sold acts as a data gathering node using shadow mode.
Wait, shadow mode?
Yeah. While you drive, the car's computer is silently predicting what it would do. If you do something different, like swerving to avoid a strange object in the road, the car flags that corner case, uploads the video data to their massive supercomputers, and trains the neural net on how to handle it next time.
So they have a massive decentralized hive mind constantly feeding the AI corner cases. I mean, that is a huge advantage. But what's the catch?
The catch is a massive structural risk that we really have to point out. It doesn't matter how smart the AI is if it isn't legally allowed to drive.
Ah, regulations.
Right. The ultimate bottleneck to monetizing this entire $20 billion pivot is the National Highway Traffic Safety Administration, or NHTSA. TSLA needs unsupervised, full self-driving regulatory approval to launch the Cybercab network.
And if they don't get it?
If the regulators say no, or if they just drag their feet for 3 years, TSLA is left with factories churning out steering wheelless cars that are legally prohibited from operating.
Man, that is a terrifying risk for investors. If NHTSA says no, that $20 billion investment is dead money.
Yeah.
But let's play devil's advocate. Let's say they get approval. Let's say the regulators give them the green light and they're ready to build millions of Cybercabs and millions of Optimus robots. Is it just smooth sailing from there?
Not even close. Because then they run into the ultimate physical bottleneck. It isn't consumer demand, and it isn't even software. It's silicon.
Silicon, like computer chips.
Exactly. An Optimus robot is, at its core, just a heavy metal mannequin without a vastly powerful AI brain. On the Q4 call, the CEO explicitly stated that if you look out 3 to 4 years, even factoring in their massive strategic partnerships with the biggest chip makers on Earth, TSMC and Samsung, there simply will not be enough logic and memory chips manufactured in the entire world.
Right, in the entire world?
Yes. There won't be enough to support the volume of AI compute TSLA is aiming for.
Okay, wait, let's break those chip terms down for us real quick. What is the difference between logic, memory, and advanced packaging, and why is the world running out of them?
Think of it like a kitchen. The logic chip is the chef. It does the actual thinking and math. The memory chip is the pantry. It holds all the data the AI needs.
Yeah.
And the advanced packaging is the high-speed conveyor belt that connects the chef to the pantry.
Okay, I follow.
If an Optimus robot is trying to process real-world 4K video in real time to catch a falling glass, that conveyor belt needs to be impossibly fast and densely packed without melting from the heat. The suppliers who build these for companies like Apple and NVIDIA are physically maxed out. They cannot build multi-billion-dollar factories fast enough to supply the brains for tens of millions of cars and humanoid robots.
So basically, it's not just about building the smartest AI. It's like trying to compose the world's greatest symphony, but realizing you first have to invent the wood to carve the violins yourself because the global supply chain is completely tapped out.
That is exactly what they are proposing to do. They introduced a concept on the call called the Terafab.
A terafab, like a gigafactory, but bigger.
Much bigger and vastly more complex.
Right.
A terafab would be a massive, domestically located, vertically integrated semiconductor factory.
Oh.
Yeah, it would handle the creation of the logic chips, the memory, and the extreme precision required for advanced packaging, all under one massive roof. They are proposing essentially becoming their own semiconductor foundry because the existing global supply chain is going to cap their growth.
Building an advanced semiconductor fab from scratch is historically one of the most capital-intensive, difficult engineering challenges on the planet. I mean, we're talking about manipulating silicon at the nanometer scale. That sounds incredibly dangerous financially for a company that started out making cars.
It represents extreme capital risk. If they attempt this and fail, it could burn tens of billions of dollars. But, if we look at the mechanism of competition, if they succeed in building a terafab, they wouldn't just solve their own supply chain bottleneck,
They'd control everything.
right? They would create an impenetrable competitive moat. No other robotics or autonomous vehicle company on Earth would be able to match their vertical integration, from manufacturing the silicon brain all the way to stamping out the physical metal body.
Wow. Let me make sure I have the complete picture here for you, the listeners. We have a company experiencing actively shrinking automotive sales, fighting brutal pricing wars, and suffering from a severely battered consumer brand.
Yep, that's the reality on the auto side.
Yet, at the exact same time, they possess a hyper-profitable, rapidly expanding energy storage division that is capitalizing heavily on the AI data center boom. And instead of playing it safe and building a cheaper car, they're making a high-stakes $20 billion gamble on physical AI, unboxed robotaxi manufacturing, 1 million humanoid robots a year, and potentially building their own semiconductor empire from the ground up to power it all.
That is the fractured reality of TSLA today. It's exactly why Wedbush sees a $600 AI platform of the future and why GLJ Research sees a $25 car company that has lost its way. It all depends on whether you believe they can execute this unprecedented, incredibly complex pivot before the capital runs out or the safety regulators shut them down.
And as always, we aren't here to tell you whether to buy or sell. We give you the data, we explain how the gears turn, and we leave the decision in your hands.
Exactly. And as you weigh that data, consider this final question. If transportation becomes entirely commoditized and autonomous, does the brand on the hood of the robotaxi even matter anymore? Or will the company that owns the silicon and the software inherently own the future?
Oh, that completely reframes the whole argument. I mean, if nobody drives anymore, a Cybercab is basically just a waiting room on wheels. You don't care who manufactured the waiting room. You just care about the software that gets you to your destination safely. We will leave you to chew on that. All right, listeners, what's your take on the future of TSLA? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Byte-Size Brief.